For the main topic today, we're going to be talking about what a mutual fund is. Then we're going to talk about what an ETF is, how they're different, and try to understand what they've got going on under the hood. We'll start with the mutual fund. If you're like me, when you started investing, you thought of the mutual fund as somewhat like this black box. And you can imagine that a black box represents a share of a mutual fund, and you just are buying these black boxes that are accumulating value. They're growing in value. They're appreciating. That's the point of investing, right? Is to grow your money. And if it's growing, why do I have to care about what's going on inside my little black box? I just need to buy a whole bunch of them, right? Well, I'm going to tell you now, especially with what I got coming down the pipeline next week, you're going to want to understand what goes inside that black box. Let's start here. What is a mutual fund fundamentally, and what kind of problem was it intended to solve? A mutual fund is comprised of a whole bunch of underlying assets, be them equities, bonds, precious metals, real estate, etc. We'll say it contains a whole bunch of securities, investments, if you will. And you get a lot of diversification within a given mutual fund. A mutual fund is supposed to help you spread your money across lots of different investments. You wouldn't take all your money and drop it into a single company's stock, especially a small company that may or may not make it over the next 10 years. You might not even feel comfortable taking all your money and dumping it into a large company that's a little more stable, because who knows, the circumstances might change around this company beyond their control, and they start to shrink along with your investment. So a mutual fund is a tool that enables you to diversify simply. You don't have to go out and research a whole bunch of different securities in order to have a diversified portfolio. You can simply buy a handful of mutual funds and know that you have successfully deferred the risk of being too concentrated with your investments. At least that's the goal of the mutual fund. Now, if you wanted to buy a whole bunch of shares from a whole bunch of different companies or a whole bunch of bonds, you're going to need a lot of money. So the mutual fund is empowered to do that by being mutually funded by many investors, thus the name mutual fund. A fund manager basically puts together a portfolio for the investments within, tells you about it, and then goes out and says, I need investors now. Investors come to the mutual fund and they say, here's my money. The fund manager then takes the invested money, buys the underlying assets, which are then directly owned by those who invested in the mutual fund. If I invest in a mutual fund that has 200 individual stocks in it, I am a partial owner now in those 200 different companies. Now that we understand what a mutual fund is and why it exists, how does it grow your money as an investment? The first might be obvious, and that's going to be appreciation. If a mutual fund is invested in a whole bunch of equities, a whole bunch of individual companies, as those companies grow in value, the share of that company grows in value. And if the shares within the mutual fund collectively, on average, are growing in value, so does your dollar. Well, more accurately, your share of the mutual fund grows in value. So your dollars that you invested are producing more dollars. Well, there are 3 more ways that a mutual fund can help you grow your dollars as an investment tool. The next one I want to tell you about would be the dividend. You see, if you invest in a company that pays a dividend, the dividend is representative of your share of the company's profits for that month or quarter or year. You see, you're an owner of the company, so you're entitled to some of the profit if that's the way the company is structured. If you're invested in a whole bunch of companies within a mutual fund, when those companies pay out dividends that go to their shareholders, the mutual fund will receive those dividends and then pass them along to you, because you're the one who actually owns the shares of those companies. Now, during the accumulation phase, it's not unusual to simply tell a mutual fund manager, hey, when I get my dividends, I want you to use them to buy more shares of your mutual fund. I basically want you to take this income and I want you to reinvest it in order to enhance the accumulation phase of your investing journey. And that makes sense, but because this is income that was generated and translated to you, if you are invested through a taxable account, something that isn't tax sheltered like an IRA or a 401k, you're going to have some form of tax is due on the dividends that are paid out to you. So that's something you should be aware of. If you are concerned about this, I highly recommend that you talk to either a tax expert or a licensed financial advisor. Okay, I said that there were 4 total ways that the mutual fund makes you money. We've talked about appreciation. We've talked about dividends. Next, let's talk about interest. Let's say your mutual fund is partially or entirely investing in just bonds. Well, when bonds mature, they pay out an interest. A bond is nothing more than a fancy IOU, right? A company or government will say, hey, if you give us some money now, I will pay you the money back plus some interest. And that's what happens when a bond matures. Say it's a 5-year bond or a 10-year bond or a 20-year bond. After they've held on to that money for that amount of time, they pay out. And when you have a mutual fund that's got a whole bunch of different bonds in it and they're maturing, that interest gets paid out to the bondholder. You, as the mutual fund owner, are technically the owner of these bonds. And just like a dividend, this can trigger a tax event in a taxable situation. Now, let's talk about the final one, and this is probably the most complicated. That's going to be capital gains. A capital gain is a realized gain when you sell a security. Now, you may not be selling your mutual fund shares, especially during the accumulation phase here, but the fund manager who is working on your mutual fund, who's trying to maintain a balance and make sure that they're investing their money wisely for you, well, they're probably going to end up buying and selling some shares or buying and selling some bonds within that mutual fund. There are many reasons why. But as they do that, because they aren't the owner of those, you are as the mutual fund owner. Well, if there was a gain when they sold it, it generates a capital gains event. Any appreciation that was attained by the shares that were sold now is realized. More or less, you experience a gain in capital by selling a security or the mutual fund manager selling the securities within your mutual fund. This can be a problem, but it can also be a benefit if you understand it. Let's talk about why it might be a problem real quick. If you're in a taxable account and your mutual fund manager is turning this thing over multiple times a year, say there's a turnover ratio of 300 some percent. Well, that means every year, everything gets bought and sold within that fund 3 times. That means you're generating capital gains or losses 3 times a year for the full amount of your investment. That's kind of wild. And remember, because this is a realized gain by you, the owner of those shares, just like dividends and interest, it is indeed taxable. So if you're trying to accumulate money in a taxable account, it can be beneficial to find mutual funds with low turnover ratios that aren't going to be generating a lot of capital gains without you actually selling your mutual fund shares. See, when you sell your mutual fund share, you will also generate capital gains for yourself. And I think this is a good place to start transitioning into how an ETF is different than a mutual fund. When you go and you buy a mutual fund, you're giving your money more or less to the mutual fund manager, to the mutual fund company. When you sell that mutual fund share for any reason, you're going to go to that same mutual fund manager and say, I would like to cash out X number of shares of this mutual fund. And a mutual fund manager typically has a certain amount of cash on hand that they can use to pay out when someone redeems their share of a mutual fund. But that's not always the case. If everyone in a mutual fund went and redeemed their shares all at once, well, the mutual fund manager is going to have to go and sell the securities within the mutual fund in order to pay everybody out, in order to have them realize that gain. So a mutual fund manager is going to be selling some of the securities in order to pay out those who sell their mutual fund shares back or redeem them. And this is really where an ETF is different from a systems perspective, but we'll get there. So what is an ETF? It's designed to solve the same problem as the mutual fund. Have a whole bunch of different investments packaged into a single share of a something that you can buy. The benefit that an ETF primarily tries to solve that a mutual fund doesn't is that it can be traded throughout the day. A mutual fund, because it's comprised of direct ownership that you have of all these different securities, has to wait until the trading day ends in order to calculate the net asset value. And that value at the end of the day is what could be used to buy or sell that mutual fund and determine what your investment is worth. An ETF doesn't have to deal with that. And this is where ETFs can get a little complicated to understand, but I like to think of the analogy of the dollar back when it was on the gold standard. If you're not familiar with the history, the United States dollar used to be tied to a finite amount of gold that lived in a vault somewhere. Basically, you knew a dollar was worth something because that gold existed and had a finite value. You know that gold is going to be a store of value, and you could, in theory, take your dollar or series of dollars, go to the government and say, I would like to redeem my money for the gold that I own. And the government would produce the gold for you. Again, in theory, that's kind of the concept. But no one wants to exchange money in gold because we're not ancient merchants with scales trying to weigh gold nuggets in order to exchange for a carpet or food. It's much easier to deal with numbers, dollars and cents. So instead of trading gold, we trade dollars, knowing that it's tied back to an underlying value. Similarly, with an ETF, you can go and trade, buy, or sell ETF shares on the stock exchange, just as if it were an individual stock. This is the same way a dollar is traded, even though it's tied to the gold. The gold itself is never sold, but the dollar can change hands many times. You see, an ETF can change hands on the stock exchange without the underlying assets actually being sold. The mutual fund, when you sell your mutual fund, you get the money back from the mutual fund manager, and they may have to sell the underlying securities in order for you to get your money. An ETF, on the other hand, you can sell to another investor, and the manager of the ETF doesn't have to do anything. Now, it's interesting because you own the ETF in this way, the way it's packaged and the way that they process it, the ETF also has a goal most of the time, this is a generalization, of trying to minimize the capital gains that are produced throughout your ownership of the fund. Remember, when you have a mutual fund and a taxable account, if you have a lower turnover ratio, you're going to be experiencing fewer capital gains throughout that year by just holding the mutual fund. While an ETF's goal, by and large, is to do that same thing. Minimize the generation of capital gains for you. And that's way easier when you don't have to sell the underlying asset in order for your fund to be exchanged among investors and for your investors to realize their gain. But ETFs are not a silver bullet that solves every problem. In fact, it can be a hindrance that they are not processing capital gains. And just the fact that they're traded on the stock market the way they are can be a problem for you, the investor. I'll give you an example. If you are trading on the stock market and the ETF that people are looking for isn't being sold very much, well, it can actually end up being sold at a premium, which means if you're buying that particular ETF, you're buying the underlying assets at a premium because they're bundled in an ETF. However, if there are a lot of shares of an ETF that are being out there for sale and not as many buyers, well, supply and demand, right? Well, you might be able to buy that fund at a deal, introducing an arbitrage opportunity. Or if you're the seller, you might be selling for less than what the underlying assets are worth. And the reason why I personally think this is a little bit of a problem for the way that I like to invest is that it introduces volatility. We talked about it in a past episode. Volatility can suppress the anticipated or likely gain that you have if you are regularly investing, if you're dollar cost averaging. ETFs can inherently experience, they don't necessarily have to, but they can experience more volatility compared to an identical mutual fund counterpart. So there's a trade-off. You have the potential of being more tax efficient if you're in a taxable account if you're going with an ETF, but you also have this increase in volatility. For me, I'm a buy and hold investor. I'm a long-term investor. I don't want to be trading my funds, my investments on the market regularly. So the benefit of being able to trade an ETF frequently or at any point throughout the day is just not appealing to me. I'm going to treat it the same way I would a mutual fund. So if I have to choose between the volatility, I'm going to largely lean to the mutual fund unless there was a big difference in the fees. There is a cost to investing in mutual funds and ETFs. This cost is often expressed in the expense ratio. This is the percentage of the amount that you have invested in that fund that goes to the fund management. If you have an actively managed mutual fund, it's probably going to have a much higher expense ratio than a passively managed ETF. By and large, you'll hear people say that ETFs have lower expense ratios. That's not necessarily true across the board. You can get mutual funds with very low expense ratios as well. Say you wanted to get a fund that tracked the S&P 500, for example. Well, there are many ETFs and mutual funds that track the S&P 500. There are many that track indices. And these index funds, be them mutual funds or ETFs, all largely have lower expense ratios than actively managed funds, be them ETFs or mutual funds. It might be easier to find a mutual fund with a high expense ratio than it is to find an ETF with a higher expense ratio, just because of the types of funds that are more likely to be found in ETF versus mutual fund form, but you can have low expenses with either. So which one's right for you? Well, there are going to be pros and cons based off of the systems that we've explained, and I think it's up to you to understand the differences before you engage with either. I firmly believe that some of the best advice that I have ever received in my investing journey is don't invest in anything that you do not understand. Because if you don't understand it, well, fear of the unknown, fear of what you don't understand can overtake you and lead you to making a poor decision that costs you. Not understanding your investments can cost you your hope-filled financial future, and I don't want that for you. I want you to be able to live out your hope-filled financial future. I want you to do it efficiently. I want you to be able to live it out effectively. I want you to live it out frugally. I want you to optimize, maximize your happiness per dollar spent, saved, and given. And that's a big reason why I delayed the podcast for a couple weeks, because next week's episode is going to be covering something I really wanted to make sure I understood and that you could understand too, because it has the potential to truly make a difference in you living out your hope-filled financial future. In fact, next week's episode has the potential to cover a topic that can shake up the investing world in a way that's never been seen before. I can't wait to share it with you. And until next week, until next Tuesday, budget bravely and enjoy your hope-filled financial future.